Hello, everyone, and welcome to this presentation of the correct way to trade support and resistance. Thank you for taking time out of your Monday to come join me. Thank you to FX Street. And today I'm going to teach you a great technique that we apply, and we also teach all of our members at Specialist Trading. For those of you who aren't familiar with my website or with me in particular, my name is Steven Primo. I am the president and founder of Specialist Trading, and we are first and foremost an educational company. Our goal is really to educate all of our students, because it's been estimated that upwards of 80% of all traders, regardless of what market, Forex, stocks, futures, will ultimately fail and lose all of their accounts. So what we try to do is give you sound education that has stood the test of time, that works. And I know this firsthand because I've been trading for 38 years. I started my career on the floor of the Pacific Stock Exchange, and I've seen and traded through every market condition. I've traded every technique and every method in nearly 40 years, and I know what works and I know what doesn't. I know what is the correct way to apply these techniques, and I know which isn't. So I'm going to show you what we feel, in our opinion, is the correct way to trade support and resistance. But we are required to show you this before we give you this lesson today. Please take a moment to look at our disclaimer. I'm going to show you a lot of performance results using this technique for trading support and resistance. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. Now, as you're taking a moment to view our disclaimer, I would also like to invite and welcome each and every one of you to follow us and get some more information. FX Street has so kindly put together a microsite for us. We can get a lot of more information and a lot more deals and ways in which to become a member of Specialist Trading. That's their link in blue, but you can also, we've abbreviated it down here in yellow, so you can copy and paste that. I believe they're going to post that later on in the presentation, so you can just kindly click that on and go there. You can also, for getting more information on us as well, follow us and go to the website as you see right here. There's the information. That's the page. And lastly, follow us on Twitter. That's our handle right there, at SPCLSTTRADG. I post a lot of great free information on a daily basis, anywhere from signals that we're currently in to daily financial wisdom. Lastly, as you may have just seen in the previous slide, our sister site is Pro Trader Strategy, so I don't want to get anyone confused. They market and promote all of my courses and strategies, and they've also created a Facebook account as well. You can go to Facebook and click on Pro Trader Strategies, and you'll get a lot more information, a lot of videos, a lot of things. So lots of ways to contact us, either through FX Street, through Twitter, or through Facebook. All right, now I have a great deal of information to present with you. I want to start out by sharing with you what I learned on the stock exchange floor. Remember, I started trading nearly 38 years ago on the floor, so I know what works and what doesn't, and I know this from firsthand experience because when I first started trading, I had a very difficult time. I probably is maybe in a scenario like many of you who are attending today, trying desperately to make ends meet, have a very difficult time. You'll have maybe 3 or 4 good trades, and then the next trade, you lose everything. It's very discouraging, very frustrating. And so my mentors were traders on the floor as well. They saw how much I was struggling, and they said, Steve, you're really overcomplicating your trading. You're applying too many things onto your trading play. So what they said to me, and it was probably one of the most insightful things they ever taught me, was that they said, Steve, it is the easiest thing in the world to complicate your trading. Anyone can do that, but it is the most difficult thing in the world to simplify your trading. And so if you look at it, this is why, one of the main reasons why most traders fail. We're overcomplicating our trading tremendously. We're looking at too many indicators, too many outside sources, too many different variables to tell us when we can enter, when we cannot enter. And if you look at traders who've been trading for a relatively short period of time, 5 to 10 years, which is relatively short actually, their trading is tremendously complicated. Lots of indicators, volume, looking at institutions, looking at the news, lots of different variables that must be met in order to enter into a trade. But if you look at the traders who've been trading 30, 40 years down the road, most of their trading plans are extremely simple, maybe 4 or 5 rules tops. So these are the ones you want to be following. The traders who've been trading for a long time and the ones that have extremely simple trading plans, because this is what has sustained them. That's the reason why they're still trading for 30 or 40 years, because their plans are extremely simple. So this is what we try to instill in all of our members: simplicity, looking at maybe 1 or 2 indicators at the most, and then just keeping things very basic, and that's how you'll get onto that road to consistency. We don't promise the world where you're going to be making thousands and thousands of percent per year and per month. We don't promise that. All we do is try to get you in that mode of being consistent. Therefore, you'll be able to be trading 30, 40, 50 years down the road, because that's really the true meaning of success. Not how much money you make, because you can easily just give that back with one losing trade the way I used to trade. It's more about being able to trade 20, 30, 40, even 50 years down the road. So just remember, look at your own trading. Is it extremely complicated? Do all these variables and requirements need to be met in order to purchase or sell? Or is it extremely simple? Is it just only looking at a few things to tell you when to get in and when to get out? All right, now I'm going to give you a lot of information. The one thing I want to just stress right off the bat for those of you who are new to my presentations, because I like to teach and because I give you so much free information that you can start using as early as today if you like, I don't like to bog down the presentation by taking questions every couple of minutes. So if you have a question, just wait till the very end of today's class, and I promise I'll get to each and every one of them, okay? So just kind of remember it, and then when we get to the question and answer portion, then I'll go over any questions you may have. All right, so here's what you're going to learn today. Remember, we're an educational company, so we like to present this in the form of a class because we're really about educating you. We're not about trying to sell you everything. We're really more about educating you so that you can become a trader with consistency. We're going to talk about conventional trading, the way most people look at trading support and resistance. And I know this once again firsthand because this is the way I used to trade. Then we're going to go into the true definition of support and resistance. I'm going to show you the correct way to trade support and resistance. And then lastly, I'm going to share with you how you can increase your odds even with this correct way of trading support and resistance. So giving you a lot of great free information. All right, so let's start off. Once again, if you have any questions, kindly wait till the end. But let's start off with the conventional way of trading support and resistance. This is what you've been taught. This is what all the courses say. This is what you read in the books or go to the webinars. Here's the standard definition. Support and resistance is a concept in technical analysis that states the movement of the price. Okay, so we're talking about basically the movement of the price, so it is technical. States a security will tend to stop and reverse at certain predetermined price levels. So we're looking at these predetermined price levels where price is either going to stop or it's going to hold or it's going to bust out, but it's these predetermined price levels. And they're based on something, most likely volume, most likely what the institutions are doing, all of this complicated way of looking at it. So here's conventional wisdom applying this. I'm going to start off by sharing with you some older charts just for educational purposes in stocks, futures, and Forex markets. Then towards the end of the presentation, we'll share with you charts that are as recent as the last couple of weeks. Okay, here's an example in Apple. Now, if someone looking at this and you read all the books and learned all the things you're supposed to be learning about support and resistance, you say, well, here's obviously the support. See, as price kind of comes down, it usually has some type of stop, and then it bounces, then another stop, and then bounces, and then starts to go higher. Okay, as we can see here, this is where the support was, and we start to go even higher. So that worked out perfectly, right? That's perfect support. Price got to some level and then stop. How about in this older chart, excuse me, the E-mini? Price is rising. It seems to hit a top here, comes down again, then goes back up and hits a top. So this is obviously resistance. Let's say maybe you've got you're looking at volume, the number of contracts. Let's say you're looking at institutions and they're all saying this is where it should stop. And hey, it works perfect, right? This is the way conventional wisdom tells us to trade support and resistance. Here's the only problem. This is what usually happens once I used to jump in and trade this. I would follow all the rules. Everything would work out perfectly. And we'd hit perfect support. Everything would look nice. And then guess what? Market wouldn't last. The support wouldn't hold. But it met all the rules, all the volume, all the institutions were buying there. Why didn't that support hold that time? Here's another chart. Here's a 60-minute time frame of IBM, older chart. Obviously, we've been going higher. We kind of hit this top. So this is meets all the requirements, either volume or institutions or indicators. This is resistance. And look what happens. Okay? This is the way most people trade support and resistance because there really is no consistency. Remember, we stated in the very first moments of this presentation, we're trying to instill consistency in you. And there is no consistency in this way of trading. Now, don't get me wrong. There are some traders who do very well trading this way, but they're far and few. Remember, we're an educational company, which means we want to educate the majority of you. We don't just want to educate so that maybe one or two of you are able to see this. We want to make things clear, concise, so that the majority of you will be able to trade this way. Unfortunately, if the majority of people were able to trade support and resistance this way, looking at indicators, institutions, volume, news, well then 80% to 90% of people would be profitable. But it's the opposite. Most people lose money. Here's another example, the euro dollar, okay? Obviously, prices becoming lower. It seems like we've hit some type of support. Let's say the institutions or volume tells us this is where it should stop, and look what happens. Remember, we're looking for consistency so that the majority of us can trade this plan. Unfortunately, the majority of us don't make any money trading this way. So, I want to give you what I feel is the true definition and application of support and resistance. This is what was taught to me on the floor by my mentors. These are traders who have been trading 40, 50 years already using this application. So it's not something that we're saying in jest or something that we're being arrogant or condescending, but they really taught me, and I've seen over the years, that this is actually the true definition and application of support and resistance. Support simply means there are more buyers than sellers at a specific point. That's all it means. We don't have to overcomplicate the definition. Now, conversely, resistance just means that there are more sellers than buyers at some predetermined point. There's no reason why to look at volume and tons of indicators. There's no reason to overcomplicate this. Support just means there's more buyers than sellers at a point. Resistance means there's more sellers than buyers. So how do we trade this then? How are we going to apply this? What is the correct way to trade support and resistance if it's really just this simple? Well, we're going to sell support and we're going to buy resistance, because since there is no consistency in support holding, we're going to sell it. And since there is no consistency in resistance stopping, we're going to buy it. So let me show you what we mean here. This is what support looks like. In its most basic form, this is what we should be looking for. It's a 3-bar pattern. It's that simple. We don't have to look at all this convoluted logic. We don't have to look at volume. We don't have to look at any type of indicators, advanced indicators. All we need to do is look for this 3-bar pattern. I see some people are saying they're having trouble with the volume. My volume is all the way up. I'll try and see if I can go even higher, but my volume is all the way up. So it must be some type of connection possibly you're having. But in terms of what I'm seeing here, my volume is tuned all the way up, so I don't really know. Let me just see if possibly I can increase it just a little bit more, but that's about it. Yeah, so it may be the connection you're currently having with your internet. Okay, yes, I see some people have rejoined and they click on again, and then it's fine. Many times if you're having trouble with the volume, just log out and come back in and it should be fine. It mostly likely is your connection. All right, so let's get back to this now. This is what support should look like. This is the only thing we're looking for. We're looking for a 3-bar pattern where we have a low followed by a lower low followed by a higher low. And all it is called a pivot low. And this is where your support is, okay? Obviously, conventional wisdom tells us that this is where we should buy. We're going to do the opposite because conventional wisdom doesn't work. Over my 38 years, I have seen no consistency in buying support or selling resistance. Actually, there's more consistency in doing the opposite. If we break this so-called support, we're going to sell. This is where the consistency lies. Now, conversely, this is what resistance looks like. We're looking for a 3-bar pattern where we make a high, a higher high, and a lower high. It doesn't matter what time frame, it doesn't matter what market, doesn't matter, what we're looking at, we just want to see a high followed by higher high followed by lower high. This is what we deem as resistance, okay? Now, this is where conventional wisdom tells us to sell, because we're going to most likely, that's where either the institutions are selling, that's where some Fibonacci number is, that's where the volume is. It's too complicated. We don't care about that. We're going to buy. If this is broken, we just jump in and buy, okay? Remember, no consistency in trading conventional support and resistance. In 38 years, I have not found any. So I know a lot of people will say, well, Steve, I've always been taught, that's too simple. I've always been taught that you have to look for something like this. This is, you have to see it touch a lot of times, and you have to see it, this is more for support. I can't believe that it's just only 3 bars we're looking for. Well, if you have trouble doing that, just remember that this hourly chart of IBM, if we go to a higher time frame, the daily chart, here is the exact same time frame. All we've done is gone to a higher level. Now this is the resistance. So it's the same exact chart. If you just go to a smaller time frame, you'll see that you'll get all of that noise and all of that pounding against some type of top that maybe you've been familiar with. But if we just go to a higher time frame, it comes just like the 3-bar pattern I told you. High followed by a higher high, lower high. So don't feel worried that it isn't complicated enough. It's extremely complicated. You're just looking at a time frame where it has condensed everything. But all you need to do is go to a smaller, and you'll get that look that you've been looking for. All right, so if we look at this chart of the euro dollar, we see here that, well, this is, people can say, well, Steve, I've always been taught, we kind of make a bottom, we rally, we kind of make a bottom again. I can't just believe it's based off a 3-bar pattern. Well, once again, if we go to a weekly chart, here's your 3-bar pattern. Same exact time frame, same exact scenario. We just changed the time frame. So in other words, don't get scared off by seeing the simplicity in this is only 3 bars, okay? Don't get scared off by that. Just look for this 3-bar pattern, because you'll know that on a smaller time frame, you're most likely meeting all the scenario that you've been taught. All right, so let's look at some Forex examples now. Since this is FX Street, let's look at some Forex examples and see how simple it is to implement. See that little short-term top? You're going to buy once it breaks out above. If you see the low, we're going to sell once it breaks out below. If we look at this chart in the Canadian dollar, obviously it's been rising. Obviously, if we tried to pick any resistance, we would have lost money because it kept going higher and higher. All we have to do is pinpoint where the support and resistance is according to what I just shared with you. We have the 3-bar pattern here. We have another 3-bar pattern to low. Now, if we broke to the downside, we would sell, but we broke to the upside, so you simply bought. Okay, now we have another 3-bar pattern here, another one, and then we have one low here. If we broke to the low, we would go short, but guess what? We broke out of all these, so we went long again, and then so on and so on. You see how simple this is? We're not looking at volume. We're not looking at what the high institutions are doing. We're not looking at news. We're only looking at the chart itself, because the chart is most likely telling us everything we need to know. And there's our buy scenarios. We know we don't have to worry about support. We don't have to hope that it's going to hold. We just simply, exploit over, resistance. How about this weekly chart of the euro dollar? Okay, obviously it's been going lower. If we had tried to pick any support, such as possibly right here, let's say the institutions were buying right here. Well, yeah, great. It lasted for maybe a couple of weeks, but then look what happened. It's more conducive just to find those so-called support and resistance areas and then exploit them. Once we trade below, that's your signal to go short. So now you're in sync with the market, as opposed to trying to pick a top or a bottom using support and resistance. There's no consistency in that type of trading. How about a monthly chart of the dollar yen? Okay, obviously we've been going higher. You just want to pinpoint the so-called overbought, or I should say support and resistance. Here's support, here's resistance, and once we break above that resistance, it's easy just to be long. Now, these are scenarios that we want to be looking for. These are easy scenarios, but oftentimes, you'll see on a smaller chart, you'll get a lot more patterns. That's okay. It's the same concept. We're looking for support, and here's resistance. If resistance is broken, we're going to buy. But since resistance wasn't broken, we just sell when support is broken. But once again, these are great scenarios. These are ideal scenarios where we're in a nice trending market. From time to time, you may see this. Here's an older chart of the Australian dollar. Okay, you apply this technique, and that's your support, and that's your so-called resistance using that 3-bar pattern we're looking for. And this is what happens. You get whipsawed. You sell when you're supposed to sell, and then look what happens. It goes back up. So then You buy, you sell again, you buy, and it looks like every trade here is a losing trade. So this happens with any strategy, with any technique when you have this type of whipsaw or rangy market. So how can we increase our odds for success using this simple technique? Well, the reason we want to increase our odds is because we want to be in sync with the trend. So we're only going to buy resistance in an uptrend. We're only going to sell support in a downtrend. So in other words, we're going to sell when we're in a downtrend. We're going to buy when we're going higher. This ensures us that we have higher probability. Where we saw that last chart of Australian dollar, there was really no trend involved. That's why we were getting whipsawed. Because the market was just in a rangy market going back and forth. Now, there's a number of ways to apply the trend. One of the easiest ways is to apply the 50-period simple moving average. If price is above, well, then the overall trend is up. And then you'll only be looking to buy resistance if price is above the 50. If price is below the 50, the overall trend is down, and you'll be only looking to sell support. It's that simple. It doesn't have to be complicated other than that. There's no convoluted logic. There's no advanced tools to determine what the trend is. You can just apply that. But let me tell you about what we feel is the best way to trade the trend. That's with trading support and resistance with the PET-D. Now, that is a proprietary tool that we have only at Specialist Trading. When you see a series of green bars in this color bar algorithm, it tells you that the short-term trend is up. And when you have a series of red bars, well, the short-term trend is down. That's how simple it is. So let's see how we would apply this. We're only going to look for price to trade above an all green pattern. In other words, all the green bars must be green, and that's our pivot high. That's when we're looking to buy. We're going to buy when price trades one tick or one pip above the pivot high, or in other words, the so-called resistance. So here's our so-called resistance. Remember, this is a good pattern, but we want to be in sync with it. So we're only going to buy when we see all three colors are green. That's how simple it is. We don't have to look at volume. We don't have to look at other tools. We just simply see that the bars are green. That's when we buy. It tells us that we're in an uptrend. Now, conversely, we're going to look for price to trade below an all red pivot point or the support, and that's when we're going to sell one tick or one pip below. So this is the all-important pattern that I just taught you what to look for. This is what support is. But in order to give ourselves a nice, high probability setup, we look for the bars to be colored red. So let's look at some Forex examples now, applying these two simple techniques and how we can, increase our odds for success. Here's a chart of the Canadian dollar going into February. Now, obviously, looking back through hindsight, Canadian dollar was going higher the entire time. So how would we have known that we were in an uptrend, though, while it was happening in place sometime in December or even in January? We apply the PET-D. Look at all the bars. They all automatically turn green. Even when we had some sell-offs or rangy markets, the bars remained green. So if all the bars are green, we simply look for that three-bar pattern I taught you, that pivot high or so-called resistance, as we see here. And once we trade one pip above that resistance, that's your buy setup. See how simple this is? We weren't trying to look and define any support and wait for price to get to a certain level and hope and pray that it holds there. We don't care about that. It's too subjective. There's no consistency in that. There's much more consistency when resistance is broken and we just jump on board in sync with the trend. How about the euro dollar? Okay, here's the euro dollar coming into February. Obviously, in hindsight, we've been going lower in the euro dollar. How would we have known to take advantage of that three-bar pattern? Well, we simply add the PET-D. All the colors are red. So we know that even when we had kind of a sideways market or we had a couple of up days here, that the trend was not bottoming out. There's no support here. If you thought that this was a support level and this was a support level, you would have lost a lot of money. We know that the trend is going lower. We're not looking for support. We're looking to exploit support. That means each and every one of those so-called support levels we're going to sell. And you see how easy trading is when we're exploiting so-called conventional wisdom, telling us where support or where resistance is. I'm sure there was a lot of traders, a lot of websites calling for support right here in the euro, and then they called for support right here. Now, guess what? We have another setup coming in right here. If we break that, what happens to the so-called support? It's much easier just to be in sync with the trend and exploit so-called conventional wisdom, because remember, there is no consistency in that way of trading. How about the British pound on a weekly basis, okay? Or if you like to trade for more investment purposes, we look going all the way back to September of 2013. The British pound was green the entire way, going all the way up into the next year into 2014. So that means all you had to do was apply this simple technique of looking for the so-called resistance. If you had tried to pick a top in the British pound on a weekly basis, you would have lost a lot of money in the past couple of years. So that's where we see how resistance doesn't work. It's much easier to simply go with it, and look at all the buy scenarios you could have had going along the British pound. It's thousands and thousands of dollars, even if you just traded one contract. Now, in August, September of 2014, guess what? We had our first red arrow. So now it's giving us a warning that most likely the trend is changing in the British pound. And then look what happened. Now, we do not find any of that pivot that we were looking for. Remember we talked about that 3-bar pivot? Well, we're looking at it, and each low is a lower low. So there's no way to find any so-called support that we can exploit. So we can go to a smaller time frame. Now the sell-off started to happen in August of 2014. Well, if you go to a daily bar chart, guess what? Look at how the daily bar was already red. So you could have gone down to a smaller time frame, seen that all the bars are red. All you have to do is apply that simple technique I shared with you. And remember, this is while the British pound was falling out of bed. I'm sure a lot of people were calling for support at all of these levels, okay? There's no consistency in conventional ways of trading support and resistance. There isn't. It will work, like, as I said, every once in a while. And there are some great traders that make a nice living trading off their trading plans this way. It just is very difficult to teach people because much of it is subjective, and much of it relies on outside sources telling us where support is, where resistance is. It's much easier and conducive to profits if you don't listen to those outside sources and just listen to the market itself. Look for that 3-bar pattern. If the trend is lower, you're just going to sell every time we go trade 1 pip below so-called support. Now, this is a daily chart. Let's just say you don't like to hold positions overnight, even though it was going in your direction. Well, let's go to a 4-hour chart. Here we are in September, the same time period of the British pound when it was going lower on a 4-hour chart. The same scenario. We're not going to change anything. We're looking for that 3-bar pattern. All of the bars are red, so all you have to do is simply sell once it trades there. See how simple it is. We're not looking at volume. We don't care what the institutions are doing. We only care what the market's doing. How about a monthly chart of the dollar yen? As we see here, this is a chart coming into this time frame right here. Once again, in 2012, on a monthly time frame, the bars turned green. Therefore, we are in an uptrend in the dollar yen. All the way back to 2012 on a monthly time frame, we've been going higher and higher and higher. All we have to do is simply apply this technique of where we exploit so-called resistance, so-called support. And since the bars are green, meaning the trend is higher, all we want to do is buy once the so-called resistance is violated. Had you tried to short on a monthly time frame the dollar yen, you would have lost a lot of money. Why? Because someone told you, or some course you took said, oh, here's the resistance in the British pound. I'm sorry, I keep saying the British pound from that last example. Here's the resistance in the dollar yen. Well, all the bars were green. We're not looking at any resistance. We're looking at an uptrend. So this means we don't want to sell, we want to buy. And the so-called resistance, there's no consistency to it. So we're just looking to go long. Now, as we see here, just this past month, guess what? On a monthly time frame, the dollar yen generated another buy scenario. So it traded above the previous high that was created in November of 2014. So on a monthly time frame, using this technique, you should be long the dollar yen. Now, we realize a lot of people aren't going to hold positions based off monthly bars. It takes a large account to do that. Plus, there's a lot of risk involved. So let's go to a 10-minute time frame. This was on the 20th, which was Friday. Okay, this is a 10-minute chart of the dollar yen on Friday, which was just the day before today's trading, the last trading day. Now, we see coming into the day here, the bars were green. So what does that tell us? It tells us we're going to exploit so-called resistance. All right, we don't believe in resistance. There's no consistency to it. So every time one of those 3-bar patterns was violated, we just jumped on board and bought. Now, once the colors change from consistency from green to red, well, then we exploit the so-called bottoms here, the support, because we know there's no consistency in what conventional wisdom tells us as support, and you could have sold. Now, this was Friday on a 10-minute chart. You think you could have made money using this simple technique? It's very easy. We don't have to have any program that you purchase. Even if you don't have the PET D, you could still apply the 50-period moving average. When price was above the 50, then you just look to go long. When price is below the 50, you look to go short. You just look for that 3-bar pattern. Don't have to spend all this money in courses and classes. You don't have to look at all these other indicators. That's all you had to do. Now, if you really want to fine-tune it, well, then the PET D, the color bar algorithm you see here, is what we feel one of our best tools for finding the trend. So let's recap before we go into question and answer. I'm sure a lot of you have questions. We shared with you what conventional wisdom tells us about support and resistance trading. Okay, it's looking for price to stop at a predetermined point and looking for price to either bottom, meaning support, looking for price to top, meaning resistance. Here's the only trouble with that. There's no consistency in that. There's no consistency. Once again, I've been trading for nearly 40 years. I know what works in terms of consistency. I know what doesn't. Provided that you are looking at, what the volume is, what Fibonacci levels are. There's a lot of people that look at that trading and look at those things, and that's great. As I stated, there are a lot of traders that do well trading that, but they're in the probably 1 to 5% that trade that way. The rest of us, myself included, have no consistency in trading conventional wisdoms, conventional ways of trading support and resistance. It's got to be simpler. Remember, my mentors taught me that it's the easiest thing to overcomplicate your trading. Looking at volume, looking at institutions, looking at convoluted indicators. It's simple. Anyone can do that. It's very difficult to simplify your trading. So that's what we do. So we try to simplify our trading. So that's the true definition of support and resistance. Support simply means that at that point in time, there were more buyers than sellers. Does it mean that that's going to hold? No, most likely it's not going to hold if you're in a downtrend. Resistance just means at that certain point in time, there were more sellers than buyers. Does that mean that resistance is going to hold? No, most likely it won't. If you're in an uptrend, it won't hold. So, the true definition is keeping things as simple as possible, either more buyers or more sellers. Okay. Now, the correct way to trade this is simply to exploit this. If we're in a downtrend, we want to sell if the so-called support is violated. If we're in an uptrend, we want to buy if the so-called resistance is violated. All right. Now, the best way to do this is to be in sync with the trend. The easiest and simplest way and most inexpensive is simply to apply a 50-period simple moving average. That's what I'm giving you today. Place a 50-period moving average on your chart. If it's a 5-minute chart, a weekly chart, a monthly chart, doesn't matter. If price is above, the overall trend is up. Then you just look for that 3-bar topping pattern and you buy once you trade above there. If price is below the 50-period moving average, well, then you're only going to be looking to go short. You're looking to sell. You're not going to buy anything. There's no so-called support if price is below the 50. So we're going to just look for those conventional wisdom points of support, and once they're violated, we will sell. Now, this is a great trading plan. You can start using this as early as today. I just caution you to paper trade first, just so that you can understand the process fully. If you want to increase your odds for success even more by using the best trend filter, that's by applying the PET D. The PET D is our proprietary color bar algorithm only at specialist trading. Now remember, it is the easiest thing in the world to complicate your trading. Anyone can do that, but it's the most difficult thing in the world to simplify your trading. Now ask yourself, go and look at your trading right now. Look at your trading plans, your methods. Is it complicated? Did you have to purchase some trading plan or some course just in order to know when to buy and when to sell? Is it difficult to figure out? Does it change from one scenario to the next? If it is that way, it's too complicated. And remember, there's no consistency in overcomplicated methods. There's more consistency in trading plans that have maybe 3 or 5 rules tops. That's it. The trading plans that don't look at outside sources such as volume, such as institutions, such as Fibonacci levels, such as news. Those are all things that, we've been taught are supposed to help us make money, but over time, it's been my experience that they don't. They actually get in the way of us becoming consistent. So once I started dropping those from my trading plan, that's when I started to become consistent. And this is what I do to my students. I teach them to let go of that and make your trading as simple as possible. So if you're interested in learning more how to trade this method with the Pet D, come to our website. There are FX Street attendee discounts for the Primo Early Trend Detector. That's the Pet D. It's a roadmap for any market. You can apply it to stocks, Forex, futures, whatever you want. It comes with many different ways to trade it, and we teach you all of this in the course. Remember, you can go to the site that FX Street built for us. Here's the link one more time. Remember, the bottom yellow one or gold is the abbreviation, so you can just cut and paste that right now. I believe they posted that as well on the chat box. But if you want more information about what we teach, our courses, or more information about how to become a member of Specialist Trading with the Pet D, simply go to that link as well. And for more information on our side, you can contact our sister site, which is Pro Trader Strategies. Remember, they market and promote all of my courses and classes. You can contact any one of their trading consultants at trading@protraderstrategies.com, or you can call them directly at area code 310-598-6677. Okay, we have about 10 or 15 more minutes left for any questions that you may have. So I want to thank you all for waiting. If you did have any questions, I'm going to open up the question and answer box right now. And I see that there were a lot of questions. There was some people had difficulty in hearing. I apologize. I think it was probably just the internet connection, because as I stated, I had the sound on as much as possible here. So I think the people that logged off and then re-logged on were okay. Okay, let's see here. First question is, Steve, why not to sell red resistance and buy green support? Well, because it's a good question, but remember, there's trying to find support. That's fine. We have different ways of doing that, but it's just the conventional definition of what support and resistance is different from our definition. That's a very good question, and I agree. There are ways to do it. In fact, in the Pet D course, we teach you ways in which to do that. But I'm just trying to steer you away from what you know as conventional support and conventional resistance. That's another webinar I'll possibly give in the future, because we have an entirely different way of defining what support and resistance, but we wanted to give you something for free to trade with right now, because that actually is included in the course. So we couldn't do that of all the people that have spent good money purchasing the course. So what we did is we wanted to give you something that you can actually trade with. And this is a method that I actually use myself. Very simple. You just look for that 3-bar pattern. But there are ways to trade support and resistance as long as you are in sync with the colored bars. So in other words, what the question is if all the bars are green, why wait for a breakout to the upside? Why not wait for some type of pullback or support? Well, that's true. We do have that. That's taught in our courses, strategy number 4, as well as the Pet D course. I just can't give away all that information right now. That would be fair to the people that have spent good money on those courses. But that's a very good question. Okay, next question. What win rate does this method have, and how do you calculate the sell stop? Well, first of all, let me just say that in order to have a win rate, or a worst case scenario or a worst case drawdown, you would have to have a system. That means you're trading it the same way each and every time. Okay, at Specialist Trading, we don't teach or trade systems. We teach or trade strategies. Now the difference is a system means that you must trade it every time, every signal generated the exact same way. You enter at the same spot, you place your stop at the same place, you exit at the same place. That's what a systematic type of trading plan is. We don't believe in those, because we think that everyone brings something different to their trading plan, that you should have anywhere from 20 to 25% allotted for your own discretion, your own insight. Because of this, you cannot backtest it, because everyone trades differently. I might enter at a different point, maybe up 1 pip. I might wait for it to trade up 5 pips. I might exit at a different point. I might get in and out very quickly, where someone can ride it as long as they want, which we teach all in the course. So there are 1,000,001 ways to trade this. We can have 2 setups using the same signals, and both people can get different results. Maybe someone will have a nice gain, someone will have a tremendous gain. Maybe someone will break even. So there's no way to have a win rate or win-loss ratio because these are not systems. We don't believe in trade systems. We only trade strategies. So we give you a basic plan. And then we allocate about 25% for your own discretion. And by discretion, we don't mean that you wake up in the morning and say, well, I feel lucky today. I think I'll buy 3 contracts, or I think I'll enter here. That's not what discretion means. Discretion is more of an insight. It's more of through paper trading and experience and knowing your own style, how you want to implement the trade. So you may be an aggressive trader. You may want to get in aggressively, or you may be a conservative trader. You may want to trade conservative. That's your discretion. That's what we're talking about. So I hope that answers your question. So we don't have any type of worst case scenarios, win-loss ratios. We don't believe in those because everyone trades differently. Plus, what time frame? Everyone trades a different time frame. We have some traders who apply this on tick charts for the Forex. We also have some traders who use this only on weekly bars. So we're not a systematic company. We don't, keep records because there's just too many traders with different styles. What we do, though, is teach you, as I stated in the opening statement, we're an educational company. We teach you sound education that has stood the test of time. These are the same things I use in my own trading that have sustained me for nearly 40 years. Now, when you're asking how do you calculate the sell stop, well, once again, that is in the course. I can't give away all that information. It wouldn't be fair to the people. But if you've been trading for any time, you can see that, you can use so-called pivot lows as a sell stop. You can use a moving average, possibly a 5-period moving average. There are lots of different ways. We teach all this in the course, though. Stop placement. We teach ways in which to use, how to track the trade, ways in which to move your stop to unchanged. This is all in the course. If you're just looking to apply this for all the free information I gave you today, just pick a standard stop. If you're only going to risk maybe $500 per trade, pick a money stop. You can do that. And then you can say, well, if I'm risking 500 and I'd like to make twice of that, then exit at where you'd have $1,000 gain. It's that simple. Remember, these are not systems where you have to exit at a certain place. You have to place your stop at a certain place. We want you to, you put your own input into how to trade this. This is how you will become consistent, not by following some predetermined plan that everyone has to trade the exact same way. Okay. Let's see. Someone is saying cable is going up at support and not being sold at, so cannot see anymore, has not support held. I'm not really sure. I'm not really sure what you're looking at. A cable. I'm not. I'm sorry. I don't know what market that is or whatever, or if that's a stock. But for 6 cable. I'm not sure what cable is. Maybe you're thinking of a Canadian dollar. I'm not really sure. So once again, just apply these techniques that we taught you. I believe this is being recorded. You can watch this video as often as you like. Let me see what other questions here. Boyke is asking, is today's equals the B bot overbought trading? Not really sure what you mean by that, too. I know there's a lot of questions here, but kind of go into more detail. I'm not sure exactly what your questions you're asking for. Thanks for a great webinar. You're more than welcome. Remember, this is all information that I've given you that we teach in our courses. Oh, okay. Cable is a British pound, a dollar. Okay. Okay. Thanks. Okay. I'm sorry, I'm old school. The British pound. I call them British, British pound instead of cable. I'd have to look at the chart. I have to look at the chart right now because I've looked at so many charts. All I keep seeing is the last chart I showed you, which was, I believe, a 4-hour chart of the dollar yen. So it's hard for me to figure. But you know the plan. So in other words, if you see this 3-bar pattern, okay, regardless if it's support or resistance, and you are in sync with the trend, then the technique calls for you to buy 1 pip above if that resistance is broken, if it's support, to sell. Now, you can go down to a smaller time frame, a 10-minute time frame. You can go to a weekly time frame. The same plan will work in any time frame. You don't need to look at the higher time frame to discern what the lower one is. It's up to you. If you want to, you can. But I do not look at a weekly chart of the British pound to tell me what to do on a daily chart. Okay, I just look at the daily chart. If that's the chart I'm trading, that's the only time frame I'm looking at. Remember, once again, keep things as simple as possible. Let me see here. Okay, breakout. Is today the breakout? Okay, thanks. I'm sorry, I'm old school, and when you have all these abbreviations and text, I'm not really sure what you're talking about. But I'd have to look at the chart in cable, as you call it, to see if it broke out. But you have all the information I've already given you. Remember, we want to put the power in your hands, so you decide, okay? But we're looking at a daily chart. If we're looking at a daily chart, look for that 3-bar patterns where you have a high, followed by a higher high, followed by a lower high, okay? If you're looking for a sell, you have a low, followed by a lower low, followed by a higher low. But you must be in sync with the trend to get that high probability setup. People will say, well, what is the trend? I don't have that PET D. In our opinion, the PET D is the best way for finding out what the short-term trend is. But if you don't have that, that's fine. You don't have to buy that to become a member or to trade this method. Apply the 50-period moving average. If price is above, you only look for breakouts to the upside. If price is below, you only look for breakouts to the downside, okay? Somebody saying cable is not conforming to this principle at present. The key words here are at present. Remember, you have to hold on to see. I showed you many examples where it busted out above or below, and for the 2 or 3 bars did nothing and then eventually kicked in. So give it some time, all right? This is a great technique, but remember, once again, paper trade. I'm not going to sit here and tell you that every technique works 100%, but look at the examples I share with you. Look at and go and do due diligence. Go look at your own examples. Look at your own trading examples, and then ask yourself, has conventional support and resistance worked for me? I can almost guarantee that it hasn't. There's no consistency. Why? Because this is the way I used to trade. I was always taught support and resistance are supposed to work, and I would have maybe 1 or 2 instances where it worked great, but it was always the next trade where I gave everything back. There was no consistency to it. Remember, if there's so much consistency in support and resistance, conventional wisdom, why aren't 80% of all traders who apply this successful? It's mostly the other way around because it's too complicated. We're looking for what volume is doing to telling us. We're looking for what the institutions are telling. We're looking for indicators. We're looking for the news. It's too complicated. Keep your trading as simple as possible, and that's how you'll get onto that road to consistency, okay? All right, I hope this answers all of your questions. I think our time is just about up. Remember, if you are interested in getting the PET D or learning more about what we do at Specialist Trading and Pro Trader Strategies, here's the information right in front of you. You can contact ProTraderStrategies.com by emailing them at trading@ProTraderStrategies.com, and you can also call them directly at the phone number given below. Remember, FX Street has put together that site for us, so there's a lot of great free information there as well. You can learn more about our courses, plus they have discounts available, so be sure and go to the microsite that FX Street has put together for us. In closing, I want to thank you so much for attending today. Thank you so much for hopefully this technique will help you and do well. Remember, paper trade first so that you fully understand the process. And please remember, as you're taking one last look at our disclaimer here, this is a great technique that I continue to use on a daily basis, and our members do as well. Okay? Thank you so much for attending today. I wish you the best of luck trading, and I shall see you next time. Bye-bye.